Welcome back to EDS, and in this video we're going to take a look at what is holding you back from mastering options trading and generating consistent returns year on year with options. Well, the first thing is that most people are buying options. They're buying contracts because it requires a small amount of money and they're hoping to turn it into a large amount of money. But nothing is for free in the market, and if you want to do that, you can do that. However, your probabilities of success are going to be quite low. So, what we're going to do and what we do at EDS is we take the other side of that trade, we sell or write the contracts to people who want to buy them, and we collect the premium upfront like an insurance company, and we enjoy very, very high probabilities of success. So I'm going to show you how to do that in this video. Now, the first thing you want to do is just navigate over to any equities underlying. We're just going to have UAL open here for the purpose of this example. Any equities underlying, it doesn't matter which one you choose. And you want to navigate over to where you can see a list of expiration dates for that underlying. And you want to lock in on an expiration date. Now, even if we're not going to trade UAL, all expiration dates for equities are basically the same. So it's not about the underlying, it's about the expiration date at this point. So we want to pick something that's between 30 and 60 days out in time. Now, it also needs to be a monthly, not a weekly or quarterly expiration date. And right now, there is nothing that actually fits that criteria. So you can either go with the January 17th or the February 21. So you can go either a little bit early or a little bit late. Now, personally, my preference here would be to go with January 17th so that you can enjoy the higher and more aggressive theta decay. But I would be looking to put on more defined risk positions being this close to expiration. Uh, Gamma risk is real. Gamma risk increases the closer you get to expiration. So you want to keep that in mind. So we're going to lock in on this expiration date here, January 17th, which is 28 days away. Now we want to take that information, come over to our watch list, and then simply filter out anything that has earnings over the next 28 days. Earnings will increase volatility up to the earnings event. This will have a negative effect on our P&L. Remember, we are writing the contracts, or another way of saying it, we are shorting the contracts. We are short the contract. Now, whenever you're shorting anything, you're basically selling high and then buying back at a lower price at some point in the future. So with volatility and with options prices, the higher the volatility is, the higher the options price is. So we want to sell when volatility is high and then buy it back when volatility is low. And assuming all else is equal, which is very rarely the case, but assuming all else is equal, for example purposes, as long as volatility is contracted, we'll be in a profit. So we want to avoid earnings because leading up to the earnings date is you can get a rise in volatility. You can do an earnings play, but that's completely separate. For the bread and butter of our portfolio, we want to avoid earnings. And also, in addition to earnings, after the volatility comes out of the market, after the earnings announcement, if the market, if the underlying moves quite a bit, that will mess up our deltas on the contracts, and that will also potentially have a negative effect on our P&L. So we also want to remove any underlying that has a low liquidity rating level. This is because we only want to trade liquid markets. We only want to pay tight spreads. The spread is the difference between the bid and ask. It's what you pay when you get in and what you pay when you get out. The tighter the spread, the less you pay. So at this point, I personally like to order my watch list from high to low IVR. IVR is IV rank, and IV rank is a metric that we can use to determine where volatility is, where implied volatility is, whether is it high, is it low, with respect to itself, i.e., that's that underlying over the past year. Because let's just see if we can find an example here. We've got VZ and CVS, right? They both have a very, very similar IV rank, basically the same. However, the absolute implied volatility level is 26.3% and 54%. So it's almost double. CVS's IV is almost double VZ. However, the IV ranks are basically the same. Well, that's because, Coca-Cola isn't going to move around as much as Tesla. So an IV rank of 50 on Coca-Cola is going to be much lower on the absolute IV side of things compared to an IV rank of 50 on Tesla. So with IV rank, it tells you where IV is relative to that specific underlying over the past year. So it's a very powerful metric. And just as we've been speaking, XOM, ExxonMobil, has just suddenly developed an IV rank of 175.5. The market has just opened. It's been open for 4 minutes. We've got an absolute IV level of 27%. Things are moving. It's kind of exciting right now. The market has had a bit of a sell-off recently due to the FOMC meeting, and that has put a lot of volatility back into the market, which is very good for us. When the world is on fire, we make more money. And when the world isn't on fire, we still make money, but just not as much. So what you want to do is order everything from high to low. And then you also want to keep in mind what's already in your portfolio. And in addition to keeping in mind what's already in your portfolio, you want to be looking at the size of these underlyings, and you want to be making sure that you're picking underlyings that will complement what's already in your portfolio. Keep things nice and diverse. Don't overthink it. Use common sense, and you'll be fine over the long term. We've got a beautiful IV rank of 174.9. We're definitely going to have a look at XOM and see if we can find a position in ExxonMobil. So let's just pull up the chart. We don't trade based off of the chart at all. We don't trade based off of the chart. However, if you want to, just for visual representation, by all means, there's the chart of XOM, but it makes no difference to us. I'm going to show you how we get around using the chart, because the chart is typically showing you past data. So it's like trying to predict the future using past data, which I get it. If that's what you do, fair play to you, but that's not what we do. So January 17th, 28 days out, that's where we want to be in terms of expiration date. This is now the options chain for that expiration date. Now this horizontal orange line here shows you where the price of XOM currently is with respect to the strikes, and this orange vertical bar shows you what the expected move of XOM is over the next 28 days. We have these dotted blue lines here which show us our standard deviation levels. So the first dotted blue line on either side is the first standard deviation range, second, so on and so forth. So what we want to do is we want to ensure we have a high probability of success. And the way that we do that is by writing contracts that are outside or just on the edge of this expected move. And we also want to line up nicely with our standard deviation levels. And also, we want to be around a 15 to 20 delta, sometimes maybe slightly more aggressive, but generally speaking, that's where we want to be. Now, as long as we line up all three of these things, we'll have a nice trade to look at. So the expected move here is sitting just outside. Also, the expected move is here. You can see in parentheses, plus or minus 4.34. Currently, is trading at 105. So we want to go with a 15 to 20 delta. Now, on the call side, there is no 15 to 20 delta. This is a situation where we're going to have to either skip XOM, or we're just going to have to force a position and just make it work. Now, in this case, we're not going to skip XOM because it has such a nice IV rank. So we're at 27 delta. We're at the 110 strike, which is just outside of the expected move here, which is still perfectly acceptable. And then we want to do the same thing on the put side. We have a bit more selection on the put side, so we'll go with the 22. We'll go with the 22 delta at the 100 strike. So we've basically created a range here for ourselves between 100 and 110. And as you can see, we are just on the edge of the expected move, which also lines up nicely with our one standard deviation level. And we are a little bit further away from the one standard deviation level on the put side, but only by $2.5. If the $2.5 strike didn't exist, the same way it doesn't exist on the call side, then it would be the closest strike to the one standard deviation level. um, and everything seems to be lining up quite nicely. Now, this green bar here shows us where our break-even points are. And as you can see, our break-even points extend past our contracts. Now, the reason why that is because our break-even is whatever our contract price is plus or minus the premium that we collect up front. So for example, what this range is basically, what this means is that we don't want price to move outside of this range, or it can move outside of the range, but by expiration we want price to be within this range, within 100 and 110. That's what we're trying to achieve here. Now, if price does stay within this range, then we keep the premium, which of $2.14. That's per share. So it's 200, and well, in this case now market's moving, so it's about $220 in premium that we collect up front. Now, if we take a look at the put side, our break even is below 100. So if market moves below 100, we're not immediately in a loss because we have the premium that we collected up front. It's like a hidden edge that we have. So our break even would be 100 minus $2.17. So whatever that works out to be, $97.82 or whatever, something like that. But whatever that works out to be, once it goes below that point, now we'll be in a loss. Now we'll be loss making or on a paper loss. So it's almost like we've got a built-in buffer in addition to already being outside of the expected move anyway. So let's take a deeper look at the numbers, or a closer look at the numbers. So this is what we would collect up front, a max profit of $220, $2.19. Our broker is going to require $3,157 in buying power to open this position, which is not the best return on capital. We can get higher returns on capital with other underlyings that may be more volatile, but it's still not a bad return on capital, and it is a naked position, which means that we have an unlimited loss potential. Now, don't be afraid of this unlimited loss potential. You won't actually take an unlimited loss as long as you know how to manage risk correctly. But that's why our buying power requirement is so high, because our broker is making sure that we have enough money in our account to cover ourselves in the worst of cases, in the worst 5% of cases. And we have a probability of profit of 63%, which means that at expiration, we have a 63% chance of making at least 1 penny on this trade, which is a very, very high probability of success. Now, if we wanted to take profit at 50% of max profit, so 50% of this number here, the premium that we collect, we've got just under an 80% chance of that happening, between about 75 and 80% chance of that happening, which is again a very, very high probability of success. Now, if this number here, the buying power requirement, was a little bit too high for your liking, if you couldn't make it fit inside your portfolio, or if it was just too much that you want to have tied up, that's completely fine. What you can do is simply just buy another contract a little bit further out, say one strike down, which is $5 wide, and you can do the same thing on the put side. Just keep the width the same to keep your risk the same on both sides. And what we've essentially done is we've now bought, or we are looking to buy, the wings on this position. And what that means is we now have a defined max loss. We no longer have an unlimited loss potential. Now, how do we know what our max loss is? It's the spread in between the two contracts, the short and long contract, minus, which is $5, minus the premium that we collect up front, which is $1.46. Whatever that works out to be, you times it by the contract multiplier. Remember, each equities contract controls 100 shares of the underlying. So you times it by 100, and this is how you end up with your max loss figure. Now, your broker knows what your max loss is, and it only now needs to hold whatever your max loss is in buying power, because that's the worst possible case scenario. So it doesn't need to hold more, which is why now your buying power requirement has gone down from 3,150, whatever it was, all the way down to under $360, which is a big, big, big difference. And as you can see now, our max profit is $150, and our broker is going to hold under $360. So our return on capital has significantly improved. Now, in turn, our probabilities of success have slightly dropped, by a couple of percent. But that's the trade-off of having such a higher return on capital. And in my opinion, this is the more desirable trade as opposed to the naked position. Sometimes the naked position is more desirable. Sometimes the defined risk position is more desirable. But in this instance, the defined risk position is better. So that's how you can find and manipulate positions to fit inside your portfolio. If you want to get, if you didn't want to do both sides, you can just do one side. If you, for whatever reason, believe that price was going to move higher, you can get more aggressive with it. There's lots and lots of different ways that you can manipulate and create these positions. The main thing with writing contracts is you have a great deal of customization, and you can essentially set your own terms before your order even gets filled, which is a very, very powerful thing. Now, if you want to know how much buying power you should be allocating to your positions, we've created a position sizing template that's free for everybody to use and get a copy of. Link is in the description. The way it works is you enter in the size of your portfolio at the top, and then you enter in whatever the current VIX level is, and everything below will then be automatically calculated for you. And at this point, you simply just need to use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power that you should be allocating to a single defined risk position, undefined risk position, and the amount of your portfolio that you should be allocating to short premium strategies in general. If you've got $100,000 in your account, you should not be writing contracts taking up $100,000 of your account. That would be silly. So as long as you follow this, you will be absolutely fine over the long term. If you want to learn in more detail about what we do and how we do it, click on EDS Premium. Link is in the description, and get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, the adjustments that we're making, all in real time. And there's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. This allows you to learn the theory and see how it's applied in real time. You can use our positions as inspiration, or you can simply copy them. It's completely up to you. If you get stuck at any point, it is a private community, so you can speak with myself directly or with other like-minded individuals, and there's a 100% money-back guarantee. So once you have studied our full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part, and right now it's £1 a month to join. The price is so cheap because we've just launched. However, the price will be increasing once you're in. However, the price is locked in for you for life, so you are definitely rewarded for getting in early. And the aim of EDS Premium here is to get you to a point within 6 to 12 months to where you can write contracts, sell premium, generate consistent returns year on year, completely without any external help, completely self-sufficient within about 6 to 12 months. By all means, you're welcome to stay and be part of the community for as long as you like. However, within 6 to 12 months of being inside EDS Premium, you should have learned this skill, and it's something that no one can ever take away from you, and it's something that you'll be able to take with you for the rest of your life. So, with that being said, I will see you guys on the inside.